Hey strangers, I'm back. And what a day it was to come back to. Of course, we had Janet Yellen with her final Fed testimony here today. We had interest rates that were raised, at least the federal funds rate were, but an interesting sell the news type of a reaction where we had the S&P 500 fall just a smidge after hitting all-time highs. And we also saw longer-term interest rates fall to some degree as well. So today in this video, I'm planning on showing you some of the areas of outperformance of the market, including one sector that's picked up a little steam here lately, and even an interesting part of the world that's starting to get a little bit more strength. So let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It is December 13th, 2017. Now, for those of you that are new, welcome. We're certainly happy to have you here. For those of you that are not familiar with me, I used to work with David Settle at our prior employer, and we're looking forward to starting a new venture together at some point in 2018. We hope many of you will be along for the ride for that as well. Now, remember, you can find us all over the internet. Of course, you're watching this video on YouTube. We'd love to have you subscribe to this YouTube video, so make sure that you click the red subscribe button to our channel that you can see a logo of in front of you. Also, while you're on YouTube, give us a thumbs up if you appreciate these videos. The more that we can build up a little bit of steam there, the greater the chances we'll be able to continue to do these free videos for you going forward. In addition to that, you'll find in the description area of the video itself some various links. One of those links would be very important for you to pay attention to. If you haven't done so already, join our daily email reminder. On that email, you'll get some special things like the various stocks that are hitting new bullish and bearish, overbought, oversold clusters for those of you that are interested in that. Many of you are already on that, so you only have to do that once, but if you haven't done so already, make sure you're joining our daily email list. Now, in addition to that, we would certainly love for you to follow us on Twitter. I would have to say that out of all the social media areas out there, Twitter is the one that David and I use the most. It's where we share our market thoughts. And like David has reminded you many times during these videos, the more that you engage with our content on Twitter, the more likely it is that Twitter will then kick to you our tweets in the future. That's kind of how it works with the behind the scenes algorithm. So if you enjoy hearing from both David Settle and myself, make sure you're liking and retweeting our stuff on Twitter. You can find me at Brandon Van Zee, all one word. And remember, for those of you that were following me at my prior employer, I no longer have that Twitter handle, so make sure you're following me at my new handle. Once again, it's at Brandon Van Zee, all one word. All right, in addition to that, we're also on Facebook. In fact, I finally broke down and just joined Facebook myself. And by the way, thank you to Claire and Kathy for already sending me recommendations on my Facebook page. That was very, very nice of you. Unexpected here within the first 24 hours, but certainly appreciate it. And again, you guys have been so supportive in this entire transition that David and I have had here in the last couple of months, and we can't thank you enough for that. So if you're not on Facebook yet and you're brave enough to join like I just did, we would encourage you to also join our Market Outlook group, which you can see there in front of you. All right, so let's go ahead and see what the markets did for us here today. As mentioned before, you can see that the S&P 500 did indeed close a little bit lower here today. It was trading higher for most of the day, but it did end up closing in the red. Now, interestingly enough, from a market forecast indicator perspective, which as a reminder are these three colored lines at the bottom of the screen that you see here, notice that we do have a specific trade setup or trigger, however you want to describe that, and it's called a bullish intermediate confirmation signal. Now that occurs when we have the green line on the market forecast that would be presented in a bullish light. Now remember, the green line can be considered bullish if it's in the upper reversal zone like it is right now, which means that it's above 80 on this market forecast indicator. And it can just simply be rising. So as an example, you can see that this green line was kind of below the 80 right here where I'm kind of pointing right now, and then it went back higher. I don't have a whole lot of examples. There's another example back here in November where you can see that green line fell out of the upper reversal zone. When it was traveling lower, we would consider that weekly bearish, but then when it turned back up and started heading towards that upper reversal zone again, we would then consider that bullish even before it got to that overbought area. So just remember, with the bullish intermediate confirmation signal, the green line just simply has to be bullish, meaning either between 20 and 80 and heading up, or just simply being above 80, whether it's heading up, down, or sideways. As long as above 80, we always consider that bullish. Now, in addition to the bullishness of the intermediate green line, we need that red momentum line to be in the lower reversal zone. So notice the difference there. With the green line, you can have just general bullishness. The red line, you actually have to have that in the lower reversal zone, meaning below 20. It can't just simply be falling between 80 and 20. So we do have a bullish intermediate confirmation signal. Now, many of you have heard David mention in the past that although the blue near-term line isn't necessarily part of the official bullish intermediate confirmation signal, he likes to get that blue line between 50 and 20 for the more ideal setups. So we're not quite there right now. As you can see, this blue line is at 66.93 and falling. You can see my labels over here will tell you exactly the point data that it's at, and then also whether it's rising or falling. So the blue line right now is at about 66.93. Again, in an ideal bullish intermediate confirmation signal setup, we'd like to see that blue line be between 50 and 20. So it might not be perfect, but the theory behind the bullish intermediate confirmation signal is kind of a buy the dips mentality. And the truth is, we've just had 4 or 5 days of upside price action. There hasn't been a lot of dips to be buying during the past week. So we finally had one of those days, and that's what that signal is telling us. Now, as a reminder, we did hit all-time highs before falling today too. So of course, the intermediate term posture remains bullish, and that's why my background color of chart is green. For those of you that remember when I used to do similar videos a few months back, when you see my green background chart on this first chart right here, it means that the intermediate term posture on the market forecast is considered bullish for this underlying security, which in this case is the S&P 500. So let's go ahead and move on to a different chart setup. Let's go to the US markets, what I call my foregrid, using the market forecast indicator. Now, in this particular setup, you'll notice the chart in the upper left is the S&P 500. The chart in the upper right is the Dow Jones Industrial Average. The chart in the lower left is the NASDAQ Composite, and the chart in the lower right is the Russell 2000. You'll also notice in this particular setup that all four charts backgrounds are green colored. So again, what that signifies when I'm looking at this particular setup is that we have bullish postures using the market forecast green line or intermediate term indicator. So good news there. Markets remain bullish. Remember, we're in a bullish time of the year as well. A lot of times you find that December, in fact, November, December, and January are part of the greatest 3-month stretch that we find. You can follow Stock Trader's Almanac to find out more information about seasonality. One thing that those of you that do follow that kind of line of thought will also recognize is that usually small caps start picking up towards the end of the year and into the new year as well. So it'll be interesting to see if that shakes out this year, because this year has been one that's largely been driven by mega cap, large cap names. Some of you saw me post on Twitter here yesterday that Boeing, out of the blue, raised their dividends 20%. Now, keep in mind, last year they raised their dividends 30%, which for those of you that are students in my income investing classes, I said time and time again that last year, out of all the dividend increases last year, Boeing was by far and away the most monumental one. There were certainly companies that had higher dividend increases, but they were less consequential. Boeing is already a world-dominating type of a mega cap company. For them to raise their dividends 50% in 2 years and already having a substantial yield, very, very impressive. So of course, Boeing going to be one of those mega cap companies in the Dow Jones that has kind of helped the Dow Jones become a leading index here, at least recently. So notice down below in the lower right-hand side, corner, I should say, Russell 2000, that's your small cap universe right there. We did have a nice little pop there today. We were up 0.55 here today, which did lead the other three indices. We didn't close at the high of the day. You'll see by the shape of this candle right here, it didn't quite close at the high, but it was still good to see us engulf, at least from a body perspective, the prior day's action. So we'll see if this year kind of transitions into one of those small caps leading the way into the end of the year and into the new year once again, like we've seen so many times in the past. But any way you slice it, again, stressing on these charts right here, we've got bullishness across the board. Of course, we're long in the tooth. Everybody knows we've been in a bull market for years and years and years, but we trade what we see in front of us. Right now, we see bullishness in front of us, and market participants are largely happy about that. Let's go ahead and take a look at a new chart setup. This one's going to be also a 4-grid. But this chart setup's a little bit different in that we're not looking at the market forecast on this one, and we'll see if it pops up here for me or not. Looks like it's oh, there it goes. This particular chart setup is looking at what we call 3 green arrows analysis. Now, 3 green arrows is just one way to look at 3 different technical indicators. We're looking at the 30-period moving average, we're looking at the MACD, and we're looking at the stochastics. And we're trying to see if we have strength in those 3 different technical indicators. And so when we're looking at this particular chart setup right here, we're looking at the same 4 indices again, the main ones here in the United States. But the difference in the color background in this case is that the green background color will tell you if those indices have 3 green arrows or not. You'll notice that 3 out of our 4 do. There's one exception of that. That is the Russell 2000 small caps in the lower right. Notice that that background color of the chart is actually white. Now, what happens when you have a white background is that there's kind of differences among our 3 potential green arrows, meaning that you either have 1 or 2 red arrows that are in the mix. And so let's explore that a little bit further. You can see that the reason for that here is likely because of our MACD. You might even have it on the stochastics here. We have a red arrow on the MACD telling us that momentum isn't quite to the place where a lot of those mega cap indices are, and stochastics are telling us that the bears are still making an effort to be in control. I wouldn't say they have the ball out and are running with it, but on the same token, we don't have the bulls that are showing much aggressiveness on that particular chart either. We do have a green arrow, of course, on the moving average, and that just means that price is above that moving average there. Now notice that the colored background of my my moving average itself is green, and as a reminder to what that means, it means that price is above a rising moving average. So you can see that this background, this moving average line can turn from yellow to red to green depending on where price action is and what the slope of that moving average is. So that would be considered mildly bullish for those small caps. Again, not quite as robust as some of the other indices at this point, but seasonality-wise might be setting up here for a little bit of a bounce. So let's keep our eyes on the small caps in coming weeks. Let's go ahead and take a look at a different chart setup. Now this one is also going to be a 4-grid, the same 4 major US indices that we're looking at here, but what we're looking at is a much longer term view of the markets here. This is what we call our 1040 crossover method, and what we're looking at here, first of all, each one of these charts that I'm looking at right now is 3 years in length. Remember, all the other charts that we looked at up until this point were only 3 months in length. We were really zooming in. This one is 3 years in length. And we can see as an example here with the Dow Jones that back here in December of 2014, we were trading at about 17,700 on the Dow, and we fast forward to 3 years later, and we're knocking on the door of 25,000. Who knows? Maybe we'll get there before the end of the year. For those folks that wanted to give Professor Jeremy Siegel a hard time about his predictions of Dow 24,000, looks like he had the last laugh. Remember, markets are designed to go up over the long term. They won't always go up smoothly or when you want them to, but generally speaking, long-term investing can be very substantial for portfolios. But point that I want to make here with this particular technical chart is that we're looking for crossovers of moving averages themselves. Each one of these candlesticks on this 3-year chart represent 1 week's worth of trading action. So this is a 3-year weekly candle chart. Now you'll see that the background colors of the chart will be either green or pink. When it's green, like it is right now, it means that this orange line is above this black line. Now this orange line is your 10-period exponential moving average. The black line is the 40-period exponential moving average. And when you have a more sensitive line, like a 10-period, crossing up and over a less sensitive line, like the 40-period, that's generally perceived as bullish. And of course, we've had bullishness for quite some time. In fact, on this particular chart for the Dow Jones, we've been in a bullish stance with this particular technical setup going all the way back to March or April of 2016. So well over a year at this point that we've had bullishness. Now, how you're going to look at this, or how you might consider using this, remember, nothing that David and I ever say are recommendations. We're not your licensed financial advisors or broker-dealers. We never will be. And so we're here pointing out things that might be useful for you to do further due diligence on. But one idea would be for your slower money. Let's say you have a 401k with your current employer that you can't really trade actively. You can't be a swing trader or a day trader or even an intermediate term trader because you don't have access to a lot of stocks or options or what have you. You might only have mutual funds. Well, a 1040 crossover method like this, what it's designed to do is it's really trying to get you on the right side of the trend. You know going in that you're not going to get out at the top and you're not going to get in at the bottom. That's what you give up. But what you gain by being willing to give up those things is by being on the right side of the trend if we go on a prolonged trend like we have in the last couple of years. I think for a lot of you, if you look back towards the spring of 2016, you'd have to ask yourself, did your performance keep up with the market in general? Now, for some of you, the answer is probably yes. But for others, you might be looking at it and saying, I didn't keep up with the market. And the reason might not necessarily be because you're a bad trader or you don't know how to identify signals well or anything along those lines. The reason might simply be because you didn't have enough of your own portfolio allocated to the market in general. It's hard to keep up with the type of market that we've had in the last couple of years unless you're 100% invested. So, of course, with a 401k, a lot of times that's how people invest. They go all in on an S&P 500 index fund or something of the sort. So if you want to kind of be with the trend, maybe this is the type of 1040 crossover method that you can use to have a few guideposts as far as what to expect going forward. So right now, as you can see, whether you're looking at the S&P 500, the Dow Jones, the NASDAQ composite, or the Russell 2000, we've got bullish crossovers across the board, and we've had them for over a year at this point. All right, let's go ahead and take a look at a 12 grid now. This is going to be our sectors 12 grid, okay? And so when I look at this 12 grid here, just to kind of, again, catch people up to speed, since I know it's been a few months since many of you have seen me on a video like this, what I'm looking at here are 12 different charts. Each one of these charts is 3 months in length. They are daily candles, so 3-month daily candles on all 12 of these mini charts. The chart in the upper left is the S&P 500. All of the 11 charts after that are the 11 different sectors that make up the S&P 500. And that reminds me, I know a lot of you already follow me on Twitter and are keeping up with some of the things that I'm posting on a day-to-day basis. But in case some of you fringe students that don't follow me so closely, a couple weeks ago, there was a monumental news item that I think slipped by a lot of folks. They weren't aware of. And I did post it on Twitter, so some of you are aware of this already, but there's going to be a big shakeup from a sector's perspective next year. I think they're targeting either late summer or early fall for this change. Some of you that have followed me in my top-down trend trading classes in the past know that one of my pet peeves is that we gave substantial weight to the telecom sector. And I always took issue with that because the telecom sector, as it stands right now, has three, count them, 3 whole stocks in the S&P 500, Verizon, AT&T, and CenturyTel. That's it. So why we give them so much of our look has always baffled me. Well, finally, there's going to be something that's done about it. What has been decided by the GICS, the Global Industry Classification System, is that they're going to basically have a new sector called communications. And of course, it's going to include the telephone companies like your AT&Ts and your Verizons, but it's also going to include cable companies like Comcast that are currently in the the discretionary sector. It's also going to include companies like Google that are in the technology sector. So this isn't going to be a minor change. This is going to be a massive change where there's going to be some significant names that are pulled out of technology, placed into communications. I'm not sure if that's exactly the move I would have made if I were in charge, but I am happy that telecom is kind of moving out of the limelight. It's overdue at this point. So anyway, want to make sure you guys are aware of that. I'll probably stress that as we approach next summer as well, just to make sure everybody's prepared for that change. But as we look at this 12 grid right here, what you can see are different sectors of the S&P 500. The background colors of the charts will tell you whether they would be considered bullish or bearish using the market forecast green intermediate line. And so you can see that all of these charts are green right now, with the lone exception of utilities. And who knows, maybe that will change as well. Utilities are actually up today. They were up 0.27 today. I mentioned before that the interest rate environment surprisingly fell today. Many of you are aware that utilities are very interest rate sensitive. When interest rates fall like they did today, now remember the short-term federal funds rate rose. Janet Yellen and company rose those. But the market traded longer-term interest rates actually fell. And so what we found here was that utilities did reasonably well here today, even though they've struggled in the last couple of weeks. You can see that the utilities had a bearish cluster, or what I should call an overbought cluster, which is what this red dot represents down here a few weeks back in November, and has really been tracking lower since then. So I'd say that that particular bearish cluster or overbought cluster did seem to play out the way that we might have anticipated. So really right now, the only one with a little bit of caution with it is the utilities. But if interest rates continue to fall in coming weeks, I would expect the utilities to do much better and start heading a little bit higher. Only time will tell. Many people expect interest rates to rise, so this might be just a little bit of a hiccup on a one-day only type of a basis. I think the Fed, one of the things they mentioned today was that they still expect to raise interest rates at least 3 times in 2018. So we'll watch that play out as time goes on as well. One area I did want to point out is this top row up here, third from the left on the top. That's your materials, XLB, and you can see XLB was up 0.27 today. I'm stressing that because our trade idea will come from that area. So just notate that that's considered bullish right now and was one of our leading sectors here today. Before we get into our trade application idea, let's go ahead and take a look at some other 12 grid analysis here. Let's now go over here to foreign markets 12 grid. And you can see, again, we have 12 3-month daily candle charts here. The idea with this particular setup is to look at 12 major markets around the world that are not the United States. Remember, there will be plenty of times, even though the United States has been one of the best places in the entire world to have your money parked in the last 5 years, there will of course be years where the U.S. is on the outs and other areas of the market, or the world I should say, are doing much better. And so these 12 here give us a nice smattering of country exposure across the globe. Now again, same concept applies. If you see green charts here, it means that the market forecast intermediate line would suggest that we have a bullish posture on them currently. If we have pink charts, that means that you actually have bearish intermediate postures using the market forecast indicator. And so as we look at this particular chart setup, we can see that Brazil in the upper left and South Africa in the lower right both have pink backgrounds. Now, I don't know about Brazil because you can notice that the moving average line is, the tail of it is red, which means that price is below a falling moving average. But look at South Africa. Kind of distinguishes itself a little bit more here. You can see that South Africa has a green tail to its moving average, which tells us that price right now is above a rising moving average. In this case, it's a 30-day moving average. Now, the other thing you'll notice is that we have a nice hold setup right here as well with South Africa. And so something to potentially keep our eyes on. Now, again, I mentioned a moment ago that materials are strong. Many of you are aware that South Africa, out of all the countries out there, is one of the most influenced by materials. Of course, a lot of gold mining companies list on the South African exchanges there. One other chart that I wanted to point out from a bullish perspective, down below here, second to the left on the bottom row is the United Kingdom, EWU. Notice that we had kind of a nice breakout here today. We closed just a smidge higher than where we topped out back here in October. We had a really nice bounce off that moving average. We have a green background color telling us that the intermediate term line is rising or above 82. In this particular case, is actually both. So either way you slice it, that's considered bullish by the market forecast. We also have a green moving average line telling us that price is above a rising moving average. And for some of you that like your breakout trades, maybe you are attracted to its breakout potential here today as well. Again, like so many other markets, we didn't close near the highs of the day, so it's not a perfect bullish setup. But I do want to point that one out because our trade idea will come from that particular area. Before we get into that, let me pop right on over here to our final 12 grid, which will be our intermarket analysis 12 grid. All right, now this is going to be a little different than the other ones in that this is not focusing on stocks. This 12 grid is going to focus on things that are not common stocks, things like bonds, things like volatility, like we have the VIX up here in the upper left. We've got things like interest rates that are on here. So here's what the interest rate environment looked like. If you right click on one of these miniature charts, you can go to maximize sell. So let me do that on TNX right here so I can show you what that candle looked like. That was a pretty aggressive candle right there. We actually had a 54 basis point move to the downside in interest rates despite Janet Yellen raising interest rates for the federal funds rate. So again, it's a bit of a sell the news type of event that we had here today. So that's an aggressive candle right there that did engulf about 3 of the prior days, as you can see. Again, the idea here is if we can't find proper stock-based setups, then maybe there's some intermarket analysis areas that we could focus on instead. The good news is we've got lots to keep our attention in the stock market right now. We have very robust markets, so we probably don't need to come on over to these types of markets quite as much. But for those of you that are looking for that sort of thing, you know, keep your eye on some of these bounces. Foreign bonds here in the middle had a nice little bounce off that moving average, and we also had a bounce for U.S. government long bonds in TLT right here. However, both of those chart backgrounds are pink, which signifies that they still have a bearish posture using the market forecast specifically. So maybe you keep your eyes on those two charts, and once the background colors turn green, maybe you have an excuse to take a paper trade on that. But with that out of the way, let's now get into our trade application example here for today. So for this, I'm going to come back over to just a regular one grid with the market forecast on it. And of course, this is the S&P 500 that we're looking at right here. But the stock that I wanted to pull up was RIO. Now this is Rio Tinto. And this is a stock that, as it comes up here for us, there we go. This is a stock that has a little bit of extra impact on those of us that live out here in the Salt Lake City area. Rio Tinto actually bought Kennecott Copper Mine. That's one of the largest copper mines in the country. You can see it from space, apparently, right here in our backyard. So despite this being a London-based company, it does have exposure here to the United States. Now remember, if you ever wanted to know where a company resided, you can come over here on the Thinkorswim platform and go over here to the Analyze tab and then click on Fundamentals. and then you'll be able to see where this company is located. In this case, you can see right here, Rio Tinto is in London, England. Now, one other quick tip for you. If you ever see a company's name with PLC listed after it, that's a dead giveaway that that company likely is in either the United Kingdom, Ireland, or so on and so forth in the United Kingdom there. So as we come back over here, I wanted to remind you that, okay, so what are some of the things that we learned here in the presentation today? Well, we learned that EWU, which is the United Kingdom, broke out today. We hit new month, 3-month highs in this particular case here today. We do have a bullish posture on the market forecast as well when we look at the United Kingdom where Rio Tinto is based. What else did we learn? Well, we learned that the materials sector within the United States at least, and likely around the world, is doing reasonably well. You can see right there. In fact, I track some sector data myself, kind of behind the scenes, which, by the way, I am looking forward to building a new sector tool. For those of you that used to follow some of my old stuff in the past, make sure you follow me on Twitter because I will be presenting that here in the coming weeks or months. Just depends on when I get it all spiffed up to the point where I'm comfortable sharing that. But one of the things you'll notice right here is that materials did tick higher week over week. That's your yellow line down below here, or you have materials last week on December 2nd that were in 8th spot. They did bump up 2 whole spots to the 6th spot here in this most recent reading that I had. So we know that materials are strong. So okay, so we're putting things together. We know that the United Kingdom's strong. We know that the materials area or the materials sector is strong. And one thing I didn't point out yet, but I think is still noteworthy in this particular case is, let's take a look at what happened to the US dollar today. US dollar got smoked today. Now that's probably because it's following the interest rate environment to some degree, but this doesn't look very healthy at all. The US dollar, if we look at UUP right here, has a pink background telling us the market forecast thinks that it's bearish. It's got a red tip of the moving average, which tells us that we have price below a falling moving average. And you have a close below the low of the high day, which is considered kind of a bearish signal here as well. If you wanted to take it a step further and look at the Great British Pound, because remember, the UUP is a quick and dirty way for you to look at what's happening with the US dollar currency, because it's really the US dollar currency versus a basket of other other currencies. But if you wanted to look specifically at our trade application today with Rio Tinto, remember, if it's based in London, a lot of its business is done in Great British Pound. So let's do GBP/USD on the Thinkorswim charts. And this will show you what's going on with the Great British Pound versus the US dollar. And you can see here a huge bounce today in the Great British Pound. We had a hold on the Great British Pound, telling us that Great British Pound got stronger today versus the dollar than it was in the 3 prior sessions. So we're getting a bounce there as well. So a lot of different things lining up. Now, of course, there's never anything that's anything perfect, but you try to tick as many boxes as you can as an investor when you're looking at various trade ideas. So as we look at Rio Tinto here, you can see that it has a green background chart, which tells us that we've got a bullish posture using the market forecast. We've got a green moving average line, which tells us price is above a rising moving average. We saw a nice uptick in volume here today, and we were up 1.89% today. That was well above any of the 4 major indices here in the United States. Plus, you can see that this green line is just recently emerging out of that lower reversal zone. So for those of you that don't like to buy the breakout types of trades, maybe this one's a little bit more your cup of tea, because this might be the ground floor that we're looking at here in the move. Now, if we look at this chart, most of you will recognize that this looks largely sideways, and I would agree with you. We have a fairly obvious line of support right down here. In fact, let's go over here to our drawings. Let's go to our drawing tool, and let's just get a line here to draw from here to here. And you can see that that is a very strong level of support. You can also see that we probably have a fairly strong level of resistance up here as well. And where are we at right now? Well, lo and behold, we're basically smack dab in the middle of that with the strength or the momentum going towards and pushing towards the upside. So what I thought we would do today as our trade application is just a simple stock trade. We're not going to do options on this because as a foreign company, it doesn't have quite as good of options liquidity as you might want. So we're going to do a straight stock trade on this. And what we're going to do is one cancels other order. We're going to be shooting for an area up here near resistance as our target. And our stop loss will be just a hair below support down below here. So I think what we'll do is about $2 up and $2 down, meaning that this stock closed at 48.60 and we're going to be shooting for about $50.60 on the upside, which will bring us right about here where my pencil is right now. And on the downside, if we subtracted $2 from that, that would be 46.60, and 46.60 would be about right here where my pencil is right now, which you can see is clearly below that support area. So we're only going to do 100 shares. So basically, in paper money, we're risking $200 of potential downside losses in order to gain $200 worth of potential upside wins. In order to place this trade, we can just right-click on the Thinkorswim chart itself. We can come down here to Buy Custom, and I'm going to do with OCO bracket. That then loads up our trade down below. I am going to change our buy limit here to 48.60, which is where we closed here today. This is, of course, after hours as I'm doing this presentation. And so we're going to try to get filled at our closing price tomorrow morning when the markets open up. Now, keep in mind, this being a foreign stock, sometimes foreign stocks gap up or down. If it gaps up and we don't get the trade, so be it. There are plenty of other fish in the sea. We can leave this as a day order because the way that the system will recognize it, if you're putting it in after hours, that day that it represents is the following day in this particular case. And this next line here in pink, that's where we're going to change it to our upside target, which again, I'm going to put in at $50.60. For that one, I'm going to put in a good till cancel order or GTC. Our downside stop loss is going to be at $2 below, which is 46.60. And again, we're going to change that to good till cancel. All right, so everything else looks good there. Let's confirm and send here. We're buying 100 shares of RIO at $48.60. We're going to sell 100 if it gets to our upside target at $50.60, and we're going to be stopped out if it happens to go the other way before we lose too much money on a trade like this down at 46.60. Both of them are one cancels other types of orders, so that way if your target gets hit, then your stop loss automatically gets canceled, or in the opposite side, if your stop loss gets hit, then your target is automatically canceled. So we'll see how that one does for us. Let's go ahead and send that one off, and we'll see if we get filled on that tomorrow. Now, I do believe that David Settle will be back with you tomorrow. This is my first attempt here, so I apologize if it went a little bit longer than we wanted, and we're going to try to work out some of the kinks if we have any technical difficulties. David had worked from home for quite some time, so he's a little bit more familiar with how to go through this presentation process. This is my first run of things here, so I'm not on official schedule yet doing these market outlook videos, but occasionally when David needs me, I'm going to be here to step in for him and then maybe have a more regular schedule at some point in 2018. So with that, thank you so much for checking this out. Again, please go over to Twitter. Make sure that you are liking and retweeting these different market outlook tweets if you want them to come to your Twitter feed a little bit more often. And again, thank you so much for your support. You guys have been amazing throughout this entire transition. With that, all the best of luck to your trades and your investments. Goodbye for now.